Good morning and welcome to the CT Private Equity Trust PLC investor presentation. Throughout this meeting, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Fund Manager Hamish Mayer. Good morning to you, sir.
Good morning, and thank you everybody for joining this webinar where I'm going to run through our interim results for the first 6 months of 2025. We have a presentation which I will probably take about half an hour or so to run through, and then there should be plenty of time for questions after that. Firstly, just take the opportunity to slightly blow our own trumpet. This is a list of the awards and achievements that we've had in the last 26 years since the company was founded. A couple of recent ones. We are top 20 best performing investment trust over 10 years. In fact, we're 9th over the last 10 years. That's all investment trusts. And we're also what's known as the next generation investment trust dividend hero, which means that we've grown our dividend every year for 10 years. You actually become a formal dividend hero if you've grown it every year for 20 years. I think we've done about 13 or 14. So these are accolades we're quite proud of. So just going to the executive summary of the results. So the second quarter numbers, so that's the quarter to the end of June, showed a slight decline in the NAV, down 1.8%. The portfolio itself was essentially flat. There's a bit of negative exchange rate movement. And this quarter comes after another slightly down quarter in the first one, when we're down 0.8%, which means we're down 2.5% in the year so far. A couple of words of caution before you start extrapolating that through into the rest of the year is that it's quite normal for the first couple of quarters of the year to be pretty quiet, and often the biggest determinant of the movement in NAV is in fact movements in exchange rate. And this is because the June numbers are essentially composed of marks that were made in March. Only about 10% of this valuation would be actually up-to-date June numbers. It's just to do with the timing of when we receive the valuations. And in March, there tends to be not that much change from the December numbers because the valuations are compiled literally a matter of a few weeks later. So typically, first half is quite quiet unless there are, large events in terms of realizations or significant change in the underlying performance of the companies. So I don't think one should read too much into that at this stage. A couple of things that are worth noting are that realizations in the second quarter of 16.8 million, which was just about the same as the new investment number. But if you look at the first half as a whole, realizations are £27.1 million, which is a bit less than the 31.2 million of new investments. And the realization number is down by about half on the same period in 2024. And that's because the market in private equity has slowed significantly. Various reasons for that, but a main contributory factor was the uncertainty that has come about as a result of the tariff situation in America, which is affecting everybody, including private equity. Uncertainty is bad for private equity deal making because people don't quite know where they are and they have to take time to reappraise. And the net effect of that is it's been harder to achieve realizations in the first half of the year. There still are quite a number, and I'll come on to talk about them in a minute, but they have taken longer to achieve. There's quite a lot of things have been delayed, in some cases cancelled, and in some cases the price of those deals have come down. So that is the principal reason for this decrease in realizations. The dividend is the quarter dividend 7.01 pence. It's the same as it has been for the last few quarters. Just to remind you, if the NAV goes flat or down, or the average NAV goes flat or down, we maintain the dividend at the rate the rate it was paid previously. So it's a kind of upwards only dividend policy, and that's kicking in here. So we'll maintain the dividend at the current level, which gives a pretty attractive yield based on the share price. Co-investments are about 40% of the portfolio. That is fractionally down on where it was last quarter, but it's very similar to where it has been. Our long-term aim is to bring that up to about 50%. But obviously we keep selling things, which is a good thing, and we have to replace them, and so it's a gradual process. We will get there at some point fairly soon. So just looking at this next slide, this just looks at the new investments that we've made so far this year. I'll talk about these in a little bit more detail in a minute. There's an IT services company in Finland called Friendly, which we have put just under 2 million euros into that. We have also committed to a new Spanish mid-market buyout fund called Keka, and we've also committed 10 million euros to Castlemount Impact Partners, which, as you can tell from the logo, is a fund that we manage. This is a multi-manager co-investment fund with an impact mandate, and that is has three different themes that it addresses: environmental sustainability, equality and inclusion, and health and well-being. And that is the key factor there is that each of the companies that find their way into that portfolio will have an impact on a sustainable development goal or one of the underlying targets, and we will measure and report on that impact. Everything else is the same as you would find in a conventional fund, including the target rate of return. And this builds on the experience that we have in co-investing and also in responsible investment. We're not, the trust is not charging a fee on those assets, so that we don't double fee on that, and neither is there a carried interest. So that is a good deal for the investors in the trust, and it's obviously helpful to us to have them as an investor in the fund. This is some of the recent exits. We're actually looking back about 12 months here, so a number of you have probably heard of this one already. This is ATEC. It's a small insurance company that was a deal that was done by Kester Capital. This is a broker and managing general agent. The lines of insurance that they're concerned with are basically caravans, beach huts, small boats, quite a niche, and the business has been very much professionalized during Kester's tenure, which was about 7 years, and they've made an excellent return, well over 4 times their money, and they've sort of quadrupled the revenue and EBITDA over that period. A lot of sort of digitalization going on, strengthening the management. A really good outturn here in what is quite a difficult sector, or can be a difficult sector. Kester are a really good example of an emerging manager that we have backed early, which have really, got into their stride in recent years and are delivering excellent returns. Amethyst Radiotherapy is one that we have just sold. So Amethyst is a chain of radiotherapy clinics right the way across continental Europe. Started in Eastern Europe, spread into Western Europe. Basically what they do is they use advanced forms of radiotherapy for the treatment of cancer. This is an underserved market all the way across Europe. The radiotherapy is much more sophisticated now than it used to be, and it's basically the treatment of choice for cancer, provided you have the machinery to administer it. And these are these big Linux machines. A picture in the, you can see the pictures of those things, and they have a good fleet of those across Europe. Business has grown significantly since we first invested in 2019. It was held back a bit during COVID, as you can imagine. Many things were, and the lead investor, the Rohatyn Group, have sold it, and we've achieved 1.8 times cost and an 11% IRR. Now, this is a bit lower than ideally we would have liked, and this is an example of a deal where the sale process straddled all these events, creating uncertainty in the global economy, and that didn't help in terms of the sale process. There were a number of other factors. I think the choice of the advisor for the sale, they chose Goldman's, and they were aiming to sell it to large private equity, and that was, with the benefit of hindsight, possibly a little bit ambitious. And secondly, there was a kind of unhelpful shareholder dynamic where one of the founders had, who still had a big stake, had gone off to work for a competitor, and he had to be removed from the equity. So that, didn't help in terms of price maximization. However, it's a perfectly respectable return. We've got £8 million in, and it was sold to another mid-market group called Fremen Capital, who are basically it's a group composed of some partners who worked for PAI. So an okay result there. We also had an exit of 4 portfolio holdings from the Inflection portfolio, and these were actually sold to another vehicle run by Inflection called Inflection Continuation Fund. Now, this is a way of actually achieving liquidity for your investors with investments that have been in the portfolio for a while, where there's been good value creation, but where there is still a good case to continue to hold, but the hold horizon to maximize value is longer than the horizon of the funds in which they find themselves. So in other words, there's good growth to be had, but there isn't enough time within the current structure to do it. So they raise a new fund called a continuation fund with different investors, although there will be some overlap with the current investor base. And you can either cash out or you can roll over and keep going. We've chosen to cash out because the returns are excellent. The largest holding here is Aspen Pumps, which is over 3 times money. But there are 3 other companies: Rosemont, which is a liquid pharmaceuticals business where they made 7 times money; Ocorian, which is a fund and fiduciary services platform, nearly 3 times money there; and CNX, a specialty pharma platform, 2 times money. So these are all good prices, and the pricing and everything is verified by arm's length investors, and this is actually quite a common process. Continuation funds where the manager continues to be in charge, but there's a different group of investors and a fresh structure is created. But we think it's perfectly okay. There are lots of advisory committees and people involved to make sure that it's a good deal for everyone, and that was the case here. Another sale. This was the sale of a remaining stake that we had in Dotmatics. Dotmatics is a software company that provides software to the pharmaceutical and sort of academic sector. It's used in the development of new drugs. It allows scientists to share scientific information securely between themselves, even if they're in other parts of the world. We actually already have realized most of this investment in 2021. 88% of it was sold then, 12% remained, and that has now been sold. The total return on the investment, including the bit we sold before, is 8.4 times cost and nearly 80% IRR. The last bit, the 12%, is 4.7 million, which we're about to receive. So that's a great outcome. It was led by SEP, Scottish Equity Partners, which are one of the longest standing relationships we have. In fact, it dates back to 1996, and they are growth equity specialists, and this is a great deal for them and for us. So those are the significant recent exits. This slide just shows you the progression of the NAV over the long term. Obviously, it's flattened off a little bit recently, but the long-term trend is still clearly positive. This is another way of looking at the performance. You can see the share price and NAV total return performance massively outstripping the stock market, but there's a bit of gap between share price and NAV. That should close itself. It is generally quite close, although with these persistent discounts, that opportunity still remains to close that gap. This is just another way of looking at the different performances. On the last 12 months basis, you can see there's been limited progress. I mean, obviously we've just had 6 months where it's gone down slightly, and last year itself was a fairly small increase, and 2023 wasn't that punchy either. We've been going through a period of transition in private equity with interest rates having gone up. That has to work its way through the system, and now we've had this latest phase of uncertainty. Now, I would say that at the beginning of the year, we felt that many of the ingredients for recovery were in place and that confidence was clearly picking up, and we saw that in a significant pickup in realizations during 2024. But that has stalled a bit in the first half. I mean, I think there's anecdotal evidence that things are beginning to pick up now. So we would hope that the remainder of this year did produce much more significant progress. This is the outstanding undrawn commitments. We just show this as a matter of routine. These are completely normal at the moment at 178 million, which is 37% of net assets, which is just below the 5-year average. We do have to run with these commitments in order to be able to recycle the proceeds efficiently, and there's nothing to worry about there. In terms of debt, the debt is just over 100 million, slightly higher than I would have expected, but that's because of the slowdown in realizations. But we expect this to come down quite noticeably over the next few months as some other exits kick in. And it's a perfectly manageable level here. We've got a lot of headroom still in our borrowing facility. And those of you who follow us closely will know that we do believe in the benefits of gearing. We tend to run with a geared portfolio because we expect that the returns that we'll make from investing in the portfolio are far in excess of the cost of borrowing. And that remains the case even now with higher costs of borrowing and slightly lower rates of growth in the portfolio. But we firmly believe that that adds value for our shareholders. So we believe very much in running with a fully invested and mildly geared portfolio. Just looking at some of the recent co-investments. I mean, this one was actually last year. I mean, I've probably talked about this a few times before, but just recapping on Accounts IQ. This is a software company that provides software for accounting for small and medium-sized enterprises. The deal is led by Axiom, who are software specialists, and this is a bit like a more modern version of Sage. Some of these smaller new companies can have an advantage over the large incumbents because they don't have lots of sort of legacy software all over the place. And this one has done well and continues to do well. We've also made a commitment tail end of last year to Inflection Enterprise Fund 6. So Inflection is an important relationship for us, and they are it's not exaggerating to say that they are the sort of doyen of the lower mid-market in the UK. A very strong record. The enterprise fund is at the sort of bottom end of the size scale in terms of the target enterprise value of companies, which is 50 to 150 million pounds, which is where Inflection cut their teeth, and they're still very good at that activity. And so we had no hesitation in continuing to back them in that area. This is the Finnish IT services company called Friendly, which we did earlier this year. This is a slightly unusual situation. I mean, first of all, we've known Procuritas. They're a Nordic buyout group for many years, and they have this holding in Friendly, which is an IT services company in Finland, which is the thesis there has been to consolidate lots of little companies into a medium-sized company. Most of the services they are providing to their customers are all about moving them to the cloud. That's a trend that's happening all the way across the Western economies, including in Finland. And in this investment, there was one of the original shareholders wanted an exit. The progress against the original business plan was a bit behind plan, and so Procuritas asked us if we would come in, but we have actually come in at a price which is below their original cost. So it's quite unusual. So we're getting in later at a lower price and would expect to get our money back faster. So why did they ask us, you may ask? Well, we've been close to them for a number of years. They know that we're an active co-investor. We know that they know that we can move quickly, and that even though it's a relatively small deal, it would be worth us doing. So they brought us in. So we think this will be a short hold, a couple of years perhaps, and we'll probably double our money in that time period. This is a new fund commitment to Spanish mid-market buyout fund Keka. Now, we've been investing in Spain through funds and co-investments for about 20 years, more than 20 years actually, and we've had a number of partners there. A couple of them have sort of fallen by the wayside, if you like, and we were looking to find a fresh relationship there, and we've done quite a bit of work on Keka, and they're very experienced investors, although this is a new fund or a new firm with a new fund. But their sweet spot is in the lower mid-market in Spain, where there's a very rich seam of opportunities, and they have the sourcing ability, and they've also got the technical ability to make money there. So we were quite happy after quite a lot of due diligence to back them. So next page just shows you the significant realizations in this year to date. I mean, there are plenty. I know we are a bit down in terms of the overall quantum compared with this time last year, which was a pretty punchy year, but there's still a lot of different things happening, companies being sold in different geographies by different houses, and generally achieving good returns. So you can see them all going over. It's a diverse portfolio, that's deliberate, and that is a strength in our view. We've also been rejuvenating the portfolio by new deals, again, a range of different geographies, a range of different private equity houses, and sectors, quite a variety. There's quite a strong technology component here in terms of software and healthcare, and that is because about half our portfolio is invested in these areas. And I make no apology for that, because that is reasonably typical for the private equity sector at the moment, and it is a function of the secular growth that is offered by these sectors. Software is becoming prevalent right the way across the economy. I think you'll all probably recognize that there are lots of applications, and these companies are creating and selling these applications all the way across Europe and further afield for different niches. And here's a few more that have come through. I mean, there are companies in here which are quite easy to understand, like Yard Sale Pizza is a pizza restaurant chain, so that's fairly self-explanatory. But others are, are quite interesting and groundbreaking. Axitara is one here done by Vaca. They basically make robots that dispense medicine to people. So we're always talking about the benefits of technology that the NHS may reap in future years. Well, some countries are already doing this with robots that dispense medicine to people in their own homes. So a lot of these new technologies, you might see them here first before you hear about them generally. This is the distributions and drawdowns profile just here for information. I mean, there's clearly a relationship where if it's active on one side, it tends to be active on the other, and vice versa. Obviously, we can control the co-investment element quite precisely, and the drawdowns and realizations from the funds, that's all a process of careful estimation looking forward. In terms of the largest underlying holdings, this hasn't changed that dramatically, but just to highlight a couple of things to watch out for. Weird Fish, which is our clothing company, where we hold 63%, is actually performing very well. We're probably going to have a refinancing there to take some of the money off the table, but it has done really exceptionally well since the new chief executive was appointed about 18 months ago, David Butler. The number 2 position is actually this helicopter company, OHI, and this is a business that's quite substantial. It's grown a lot. Sterling Square are the lead manager. I mean, they're quite keen to sell it, but they've struggled to exit it at what they regard as an acceptable price. It's based in Brazil. It services the offshore oil industry in Brazil, and that actually means, that coupled with its size means that there are a limited number of buyers, and so it will take time to find the precise buyer there. But in the meantime, the business is actually trading very strongly, so we're quite happy to wait. Sigma is an electrical components company. I think I've probably mentioned this before. It was our largest holding. This is one of the few businesses in the portfolio where there is a direct exposure to the change in tariffs in America, because they export from their factories in Mexico and India to the States. So they've obviously had increased tariffs put on them. However, their components are a small part of the end product, and they have passed on price increases to cope with the tariffs, and these have stuck so far. Now, it's difficult to tell what the long-term impact will be. That will take a little bit of time. So it appears not to be affecting the profitability of the business immediately, but what it has done is affected the ability of Argand, who are the lead manager, to sell it, because that's quite a significant amount of uncertainty injected into the sort of decision-making process. So that will take longer to sell than we had thought. It won't happen this year. It will happen next year or possibly later. The others are in reasonable shape. Utimaco, which makes these security tokens, that's a growing market. That's been trading well. Hoffy, that's otherwise known as San Siro, that is our funeral homes business. We've already sold 3/4 of this. This is the quarter that we've got left, and that's doing fine. TWMA is the processor of drill cuttings from oil rigs. Now, this business has shrunk a little. I mean, it's down about 10% year on year. It's a fairly difficult market, and they've moved quite a lot of their operations closer to where the main market is now, which is in the Middle East. But we still aim to exit probably next year. Aurora Payments is going well. It's still quite early days there. Cyclomedia, which is the street mapping software company is also going well. Amethyst we've just sold actually, so that won't be in the list next time. And Breeze, which makes equipment for clean rooms, is in reasonable shape. So the top 10 account for just 22% of the portfolio. So we've got a good spread, but these are the ones to watch out for because these can move the needle. In terms of the geography, it's not much changed. I mean, we've got 41% in the UK. We like the UK market because we're based here and it's the biggest and deepest private equity in Europe by some measure. We have more exposure to the UK than our peers. I mean, most of them have got a few percent in the UK, mainly invested in America. We've got a little bit in America. Most of the rest is in continental Europe, which is our sort of core market. In terms of age, about 60% is over 3 years old, 40% over 4 years old. The typical hold period is 4 or 5 years. So after about 3 years, if things have been going according to plan, they will be planning an exit. So this is, we monitor these 3 and 4 year old companies because it gives an indication of how much mature stock you've got coming through. Now, we always have some coming through. It does fluctuate a bit, but there's plenty of candidates for exit when the conditions are right. The average valuation across our co-investments, which is nearly half the portfolio, is 10.9 times EBITDA, and that's actually almost exactly the same as it is for the overall portfolio, which is 10.6 times. And in terms of debt to EBITDA, the co-investments are 2.7 times, so it's not particularly highly geared. It's quite low, in fact, and that compares to 2.5 times for the overall portfolio. So the co-investments we have immediate and easily available data on them. The overall portfolio, it takes a bit longer to compile that, but we do have that data. But the point is that the co-investment portfolio is fully representative of what we have in the overall portfolio, which is not a big surprise because we are investing alongside the funds. On sector, as I mentioned earlier, healthcare and information technology, which information technology is mainly software, but it also includes hardware. Healthcare is, care and services in the care industry, as well as life sciences, pharmaceuticals, medical devices. But if you take these two sectors together, they account for about half the portfolio. We've still got plenty in industrials, consumers, financials, and this gives us, this diversification is a strength. As you probably heard me say before, I think the only way to handle the naturally high risk that you take on when investing in private equity is through having a diversified portfolio, and that provides resilience. You can see throughout our 26-year history that has been a great benefit to us. So to conclude, I mean, last year was a sort of a year of stabilization and a bit of recovery with a big increase in realizations. This year, the recovery, which we saw taking root in 2024, has been impacted. It has stalled a bit, and that's because of the uncertainty that has been engendered. And it's obviously we're not the only people that are affected by this, everybody else is as well, but it's very clear in the numbers. We think there are plenty of the ingredients for recovery are in place, but confidence and a more certain environment is a key one that has to occur before we'll get that recovery. We see excellent deal flow for funds and co-investments. I mean, there's been some really excellent propositions that we've seen recently. Obviously, we only take a very small proportion of those, and these will all lay the foundations for future growth. we've got a strong balance sheet, we've got plenty of resources, a really well diversified and resilient portfolio, and the underlying companies are in good growth mode. I mean, they're still growing their profits at about 20% per annum. Revenues slightly less than that, but really good growth, and that will manifest itself in value in due course. And so we are confident that the company will continue to grow value for shareholders over the short and longer term, and very probably in the second half of this year. So that is there are various appendices in here, but that's the end of the presentation. So if people have got questions, I will do my best to answer them.
Yes, thanks, Hamish. I'll help out in that respect. My name is Peter Brown. I work within the investment trust team at Columbia Threadneedle. We've had a couple of questions. We have quite a few questions come in, and I'll please encourage you to submit more if you've got any to mind. We had a couple that came from the AGM a couple of months ago. One's a bit technical. Why did the audit fee substantially increase from £75,000 to £110,000? What's the expected level of fees for the current year, please?
Yeah, the audit fee increased because audit fees are increasing across the board. Part of this is that they are required to do more work. The sort of guidelines in terms of what the level of scrutiny that they're expected to apply have changed a bit. I think for many years audit fees were surprisingly low. So our audit fee went up from 73 up to 110. For a £500 million company, that is not a particularly high fee. And I can tell you that when we were looking at other auditors who were proposing fees, in every case they were a lot higher. So 110 is pretty good value. I mean, when I say a lot higher, I do mean a lot higher. We had, I think, there was one quote where we were quoted about 300,000. So 110 from BDO, who are an excellent firm, is good. We wouldn't expect the fee to go up dramatically from here. It will be more like a sort of inflationary increase from here.
Thank you. You mentioned the discount on the trust. It's around 30%. The question is, does this make it vulnerable to S-type activists?
Well, I mean, I think there's no room for complacency when you have a large discount to NAV. But there's quite a big difference between a private equity trust and other trusts that are invested largely in listed securities, because an activist who will buy in at a discount and then subject the company to various pressure in order to get them to realize all or part of the portfolio at or close to NAV would be asking a private equity company to do something which is quite difficult. I mean, they can't suddenly take control and then sell the entire portfolio just like that, unless they are specialists in private equity. And even if they were, it would take them some time. So, as I say, there's no room for complacency. But I think the plan that an activist might have, which they may feel is relevant for an investment trust that's invested in the quoted market, would probably be a completely impractical plan for the private equity market. Obviously, if they are private equity specialists, or it's another private equity trust, who's very familiar with the subject matter of the portfolio, the contents of the portfolio, then something could be done there. But what we're doing is concentrating on trying to reduce that discount by fundamental methods. In other words, encouraging more people to buy the shares than sell them, and to explain that there is real value here, and that if you're a committed long-term investor, you are likely to see that value. And for various reasons, the whole sector has been languishing on a relatively wide discount for some time now. One of the arguments has been they don't believe the valuations. Well, I think that is demonstrably untrue, because when we sell things, we sell them on average at a very significant premium to the previous carrying value. So even in tougher periods, such as the one that we've just had, I mean, the weighted average premium on our exits in the first half of this year, which was a sort of subdued period, was still low to mid-teens above the previous carrying value, and in most years it's more like 30% or better. So there are very good reasons to take advantage of the discount, from a fundamental point of view.
Long-term shareholder here asking a question. I've been in the trust for 15 years and I'm generally happy with returns. However, the capital value has flatlined since September 22 and performance has lagged the AIC Private Equity Index over 1, 3, 5 and 10 years. What are your prospects for more regular profitable realizations, capital and income growth over the next period?
Well, as I mentioned in my presentation, there obviously has been a quiet period in the last couple of years, and I also think that now plenty of the ingredients for recovery are there, and if it wasn't for all this tariff nonsense, I think we would have seen more of that, and we may well see that fairly soon once people have sort of processed the impact. In terms of the stats that have been cited there, I think he's looking at the AIC private equity sector, including 3i. The 3i is essentially a very concentrated portfolio with one company that's performed very strongly. So most people that are comparing performance against the peers to exclude 3i from the analysis. And if you do that, we are outperforming the sector over 1, 3, 5 and 10 years quite nicely. And you've seen the charts earlier where you've seen absolute outperformance over the long term. I mean, on the 26 years since we started, we've outperformed the stock market by about 4.5 times. So, I think when we have these quiet periods, it's important to be patient, to see through that, to continue to invest, and hopefully reap the benefits as we return to a more typical rate of growth soon.
Thank you. Could you explain the structural attractiveness of the small market compared to the large market in private equity? Why are the returns often better in the small market?
Yeah, the lower mid-market buyout market that we invest in. So these are companies with an enterprise value of less than 500 million. And our sweet spot would be less than about 150 million. And why do we like that? Well, it's a very broad, inefficient market, and therefore a diligent and careful investor can buy well. In other words, they get in at lower prices. Even though the gearing put into these deals is typically lower than it is for large deals, the returns are better. There's the smaller companies can grow faster than bigger companies that are starting at a smaller base. Most of the companies in our portfolio are niche businesses that are concentrating on one particular product or service, sometimes in one particular market, and they are only selected for private equity portfolios if they've got good, strong growth characteristics. So you're getting essentially, we are investing in a small subset of companies that private equity managers have found. I mean, across the continent of Europe, there are tens of thousands of businesses that are in the size bracket where private equity might be interested, but only a few hundred actually receive private equity every year. And these are the ones with the best growth characteristics. And that's one of the reasons that we outperform. Okay.
Sorry, thank you. Next question. What are the most common reasons for removing a manager from the portfolio, or in other words, not reinvesting in the next fund? Do you find that managers try to run too much money?
Yeah, I mean, the most common reason is that they've failed to deliver, i.e. there's, poor or lackluster performance. They've had too many deals that fall over. Now, we're typically not going to invest in a fund unless we're pretty sure they can do a 20% net IRR. Now, you know, if they achieve 17 or 18%, we're not going to get too upset about that. But if it turns out to be 6 or something, then that's you know, that's obviously not good enough. We're taking all that risk and we're not being rewarded for it. So, you know, we're always appraising how each of the funds that we invest in, or the co-investments, how they're doing compared with what we expected when we invested. Sometimes people will try and raise too much money and therefore struggle to invest it wisely or sensibly. So that's one of the things we're always on the lookout for. If somebody has done a fund at 200 million, and then the next fund they raise is 800 million, and it's a perfectly legitimate question, you know, how are you actually going to invest 4 times the money in the same time period as you have done before? If you start buying companies that are worth 4 times as much, then that's a different part of the market to the one where you've made your track record. So these are the sort of discussions that we have all the time with fund managers. And if we think they're being over ambitious or perhaps garnering more money than they can actually usefully deploy, then we will hold back, or we won't invest.
Thank you. Quite a direct question here from one of our viewers. Have we increased our holding in Northern Gritstone?
No, we have same position as we had when we went in a couple of years ago when it started. We have a £5 million commitment to Northern Gritstone. So Northern Gritstone is the university spin-out company for the universities of Manchester, Sheffield, Leeds, and now Liverpool. So it's full of really interesting early stage science-oriented businesses. And I was at their annual meeting a few weeks ago, very upbeat, lots to go for. It is a long-term investment, so it will take time to show, you know, a lot of appreciation. But one of the reasons I actually made that investment is that wearing one of my other hats, I chair the investment committee of a fund called Old College Capital, which is the Edinburgh University spin-out fund. And through that role, I can see the potential of university spin-outs. We've had some good exits there. And I think a similar kind of thing is going to happen with the Northern Gritstone Fund.
Well, funny enough, that ties in quite well with a question we've got today. Do you come across any young companies that arise out of universities as spin-offs? And what is the health of university spin-offs in this country? There seems to be quite a few technological breakthroughs that hit the press, but these do not develop commercially. If you can expand on that a little.
Yeah, no, that's right up my right up my street. I could speak for quite a few minutes or an hour or so on this subject, but there are lots of university spin-outs. I mean, the Edinburgh portfolio that I've got direct experience of, we have, you know, it's probably about 70 companies altogether. These are generally too early stage to come into this portfolio because this is focused on management buyouts. They are all venture capital, early or all early stage, and they vary from being seed stage to sort of Series A or Series B, as they call it. So they generally have a pretty high risk profile. So if we were to put them into this portfolio, we would have to have a portfolio within a portfolio because of the innately high risks involved. There are some amazing technologies coming through, really exciting in terms of quite often healthcare and science. You know, I could talk for quite a long time about the various things that we've seen there. Also, ones that are connected to the environment and climate change, and some really sophisticated forms of software, a number of which are connected into AI. So the university spin-out sector in the UK is strong, and it's getting stronger. You know, in America, they've done this for longer. It's stronger there. But I think if you compare the British situation with what's happening elsewhere in Europe, it's significantly ahead of them. I think there's it's a really interesting sector.
Thank you. I'm going to try and merge 3 questions, which is always never a clever idea. But basically, the theme is about gilt yields, base rates, dislocation, certainly at the moment, between the two, fiscal policy. How is CT Private Equity Trust positioning itself to mitigate the adverse impacts and capitalise any investment opportunities? And I'm going to merge this with, you remain optimistic in the short term, but given the uncertainties in geopolitical and tariffs you referred to earlier, why are you optimistic? And thirdly, how much of an impact do uncertainties about the UK economy, along with government fiscal approach in the long term, have an effect on CTPE?
Yeah, I mean, we're obviously not immune to it. I mean, we operate in the various economies as everybody else does. Obviously, interest rates have gone up, although they're coming down a bit now. And so the cost of capital has gone up, and therefore you have to be really sure that you'll make an adequate return in the investments. There can be adjustments in pricing that come through, and we've seen a bit of that. That is an opportunity. I mean, we try and invest in businesses where there is a growth dynamic which is not directly or closely linked to economic performance. So looking for trends that will continue even if the economy is sluggish or even in recession. And I mean, you can see that in our track record. I mean, we've been going through a number of financial crises and things, and most of the time we continue to grow quite well through that. And that's because of the focus of the private equity managers that we back. They're finding strongly growing companies. They're not overpaying. They don't have to deploy capital into those companies if they don't want to. They can quite easily sit and wait. One of the strongly observable features is that private equity deals that are done either during or in the immediate aftermath of an economic slowdown or recession tend to make better returns than those that are done before that. You can have a few percentage points extra return. And so I wouldn't be surprised if that's what we saw over now and over the next year or two. So that is an observation that's based on experience. So I'm pretty sure that will happen. The private equity model, which is all about aligning interest between the investors and the management of the companies, is very strong. It's a model where capital is provided with expertise in a way that most asset classes they just get capital. You don't necessarily get expertise in the investee companies, and that has proved itself really powerful. I mean, it's no accident that the strongest performing investment trusts over the long term are private equity ones. We're one of them, but there are others as well that are up there, and it's because they're looking for secular growth. They're looking for companies that can grow, despite rather than because of economic growth. But we've got to watch all that stuff carefully because interest rates have gone up. Obviously, we're investing in management buyouts. There's a significant amount of debt in the capital structure of the underlying businesses. If they are overgeared and they don't do very well, you can lose everything in terms of the equity, and that does happen occasionally. I mean, that is one of the inherent risks that I was mentioning earlier on. So that's why we're really careful with who we invest with, which companies we invest with, and we make sure we don't over concentrate the portfolio, and it retains that diversification, which is a real strength, and we can demonstrate that if you look back at the history.
Lovely.
Covers that.
Yeah, I think we did cover that. We're getting close to the hour. We've maybe got a chance for one or two further questions before we wrap. Yep. If there are any questions we haven't gone to, we will post a response on the IMC website, so you can look for that a bit later on. But next question, you have 5% which are pre-2014 investments. Are these really zombie companies which are worth very little?
No, because if they were zombie companies, they wouldn't actually they wouldn't show up on that analysis. If there were zombie companies, they would be down at zero. There are some companies that are at zero and which are still, still alive, if you like. The investments are still current. It may be that they're just the equity value is kind of crushed by a layer of debt above it, but that isn't necessarily a permanent situation. A lot of these companies that have been in the portfolio for a long time can have a sort of late period flourishing where the original investment thesis has not played out the way that was expected. It's probably taken longer. It may have actually failed, and they may have a subsequent investment thesis and even a subsequent one to that. The businesses are reoriented, new management, and you can still make an adequate return. Obviously, the longer it is in the portfolio, the all things being equal, the return is going to come down. But there are businesses which do recover, quite late in the day. And interesting, we did an analysis on this because this is a sort of question we get quite often. Everyone says, "Oh, that old stuff must all be dross," and then we've looked at, where the old stuff is then subsequently exited. The returns are quite reasonable. They're not brilliant. I mean, I think from memory, when we looked at the really old ones that had exited, on average, they were achieving around about a 20% IRR, which is a bit less than our usual target of 25% plus, but it's not bad. So it is wrong to think that sort of stub, if you like, is all rubbish. It's not.
Lovely. Can the current dividends be paid out at the current level over the next 5 to 10 years, is the question.
Will be maintained at the current level over the next 5 to 10 years.
Are the dividends sustainable? Yeah.
Well, we expect it to grow. It will grow in line with NAV, and we expect the NAV to grow substantially over the next 5 to 10 years. So that the current dividend level will not go down; it will go up as soon as NAV growth resumes, which hopefully will be soon. You'll start to see the dividend grow, and it will grow in tandem with the NAV. It's set at a level that we are sure that under any foreseeable circumstances we can maintain it. So we believe the dividend is safe, and it will grow nicely from here.
Lovely. I think our final question for the moment, with the push towards private assets by the UK government, are you approaching smaller UK pension funds?
Well, we have some pension funds who are already in our shareholder base. We've got several, actually, who always have had. And in fact, I would say the more sophisticated pension funds regard a position in our shares as actually, a significant part of their private assets allocation. And it has the advantage to them that they can flex it. They can increase it or decrease it depending on the overall size of their portfolios or of what they're feeling about the asset class. So this company is a good investment for a small and medium-sized pension fund, and indeed we have several in the shareholder base. So the UK government is encouraging pension funds to invest into UK private equity. I think that's a good thing. I think it's a highly sensible recommendation. We have over 40% of our portfolio in the UK, which is more than most of our peers, most of whom have got their portfolios spread all around the world. And so if you want to put more money into UK private equity quickly, efficiently, and with somebody that has a good track record, they should buy our shares. So I should maybe get Rachel Reeves to make that point next time she's speaking up in public about this.
I think it's just come up that she's going to have a chat with us all in November. Anyway, we'll leave it there. Thank you very much, everyone, for your questions. We got through as many as possible. We will answer the rest online. We will have another update in about 3 months' time. We like to do these roughly quarterly. But if you can give us your final comments, Hamish, and then we'll wrap up.
Well, thanks very much, everybody, for listening. Thanks for your questions. Thanks for your support as shareholders. Obviously, we've had a quiet period recently, but I hope from what I've explained, you'll believe that we are going to have a better period coming up. the deal flow is very good. There are lots of good companies out there. Realizations are still happening. We expect there'll be a reasonable pickup in the second half, and realizations do tend to drive growth in net asset value because they're happening at a premium to the carrying value. They basically are a good indicator of confidence, and confidence creates value in this sector. So I would encourage you all to stick with it. I know the discount can be a bit irritating, but the other side of it is it does provide a great opportunity. And as I always say to people who are investing in private equity, do it for the long term, and do it regularly. And after a few years, you'll look back at your portfolio, and hopefully you'll see a very substantial gain has been created. So thanks for your support, and I look forward to having further discussion with you in a few months' time.
Well, that's great. Hamish, Peter, thank you very much for updating investors today. Could I please ask investors not to close this session, as you now be automatically redirected to provide your feedback, and all the management team can better understand your views and expectations. On behalf of the management team of CT Private Equity Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.